Hello, folks. Welcome to the mentorship. I know it's been a long time since the last installment, and you know, it had to be this week, really. Not because I really planned for it to be today, but because of price action, and there's just a lot of talking points on this one, and it would be unfair if I left this piece of price action, um, if I left it out of this you know program, because you know this one is very interesting, and I know someone saying, "What are we doing forexfactory.com or Forex Factory?" and today I'll be talking about interpreting the economic calendar, right? And why am I talking about the economic calendar? It's because it is pretty important, and a lot of folks think they probably understand this news driver, and I don't think I might be able to like completely cover everything I'm supposed to say, because there's a lot of things to say, and the more I talk and buttress on facts, I might end up omitting other talking points. But I promise you, I would try as much as possible to remember and remind myself of all of the things I want to say about the economic calendar. Because if you're learning, trading forex from me through this program, there's no way you'd have the full package without understanding the economic calendar. And there's something you want to note. You want to understand that the way I trade, I just understand price action, right? I understand price action, and I use it to determine bias, determine when I need to trade, when I need to stay out, and stuff like that. It's all price action. Um um it's manual. Okay, that's how I put it. Okay, it's manual. So there's nothing to tell you that it's not, how would I put it? It's not like some strategy where a strategy that just tells you to buy and sell and stuff like that. No, you do when to buy, you do when to sell, and you do when not to trade at all. You get it. Very, very is all encompassing, and you can't do this without learning the economic calendar, because the economic calendar is such a a pivotal part of my trading system. And as you know it, we are in the day trading saga. Okay, from the last video in the mentorship, that's market profiles and profiling, we already entered the day trading saga, because everything we're learning now, it's for day trading. Okay, it's for day trading. Now, it doesn't mean you can't use this information for short-term trades or long-term trades, but they would majorly play a role in how to define high probability sessions or time of day and stuff like that. So that's why I say it's called to day trading. So before we got here, we talked about a lot of things. We talked about the draw on liquidity, for example, and we kind of like defined it in two segments. We talked about it from the quantitative perspective, and we talked about it from the qualitative perspective. And you all know currently we've been looking at the draw on liquidity from the qualitative perspective. Prior month, we've been looking at the draw on liquidity from the quantitative perspective, and you can see how interesting this market is. There were periods when institutional, high time for institutional order flow defied the laws of qualitative analysis up until now, and now markets are refusing to be in sync with data, right? And we've been using just candlesticks, market structure to define what the draw on liquidity would be. And we also moved on to validating the high time from institutional order flow, because whether you have a long-term bias, a short-term bias, a daily bias, you need market structure to validate that bias. So you're not trading blind, or you're not gambling essentially, because you can have a bias and be wrong on that bias, or you can have a bias and the market doesn't deliver the way you expect the markets to deliver. So if you have actual trading systems and stuff, this can protect you for periods when you were supposedly wrong about how the markets will trade. Okay. And this week, for example, is a very crude depiction of how you can be right on bias, but the way the markets would deliver that bias might be really, really exhausting, right? But I'm going to leave market review for the commentary, and I'll try to stay as much as possible away from talking about, um, you know, price action and stuff like that. I just want to focus on, how to blend in the economic calendar to interpreting price action, and definitely how to get trades and setups from it. Now, before I continue, I think it's been a while since I talked about how I said, if you're listening to this right now, you should like the video and subscribe. So, really like, and if you appreciate my work, I would be happy if you shared this to friends, family, your community, whatever. Just share it and encourage them to subscribe, because I think I've been stuck in about 300 plus subscribers on YouTube, and I haven't really been pushing because I actually got tired, and I feel like I want to push again for more subscribers. It's really encouraging, because periods when I was getting new subscribers, literally like every week, I was very encouraged to make videos like this. So it encourages a lot, and for some reason it just feels like people are noticing you and you need to drop more quality stuff there, you understand? So I think I've been lacking on that. So please subscribe and share with friends and encourage them as well to subscribe. So yeah, I'm done with that. So now, what is the economic calendar, and how do I interpret all of this in red folders? So for your note, okay, what these news drivers are, okay? The news drivers. No, economic calendar is actually a schedule for the news drivers. So we're literally talking about the news drivers, even if the title of this particular module is interpreting the economic calendar. Okay, I think the economic calendar sounds more pleasing than news driver. So you want to write this down. Okay, the news drivers. Yes, before I jump on the news drivers, there's a reason why I was talking about the draw on liquidity and stuff like that, because there is absolutely no way. Okay, you need to note there is absolutely no way for you to successfully interpret the news drivers without understanding what the draw on liquidity is. Okay, and that's the reason why I said everything starts from the draw on liquidity, and that's why it's the first lesson, and that's why we talked about it extensively and ways to define what the draw on liquidity is. You understand? Because if you do not know the draw on liquidity, you can't interpret market structure. Okay, you simply cannot interpret market structure, and you cannot interpret the news drivers. It's not possible, because when we look at the markets, we're looking at the market from the probabilistic perspective. Okay, and what I mean by the probabilistic perspective is that the markets can actually do whatever the markets want to do. Okay, and the markets will be right at the end of the day. So is there a lens through which we can look at the markets that gives us that balance, that neutrality? Okay, that tells us, okay, when the market does this, okay, we can understand this. When the market does that, we can understand that, and it still stays within the frame of logic. Okay, for example, how we describe turtle soup, for example. We say turtle soup is the run below an old low, and we also say when the high time frame, when market structure shifts as opposing to the direction of the high time frame draw on liquidity, that's also turtle soup. For example, if a market is bullish and the market runs below an old low, no, that's not characteristic of a bullish price action. Okay, if markets are bullish, you want to see the market trade make new highs and preserve previous lows. That's what is characteristic of a bullish market structure. Okay, so when you see the market trade below an old low and the high time frame institutional order flow or the draw on liquidity is on probably the buy side, okay, and market trades below a significant low, that's torso. In quotes, significant low. Now, there are different ways to define which low is significant or not. You can look at it from the perspective of, the candlesticks, for example, the daily time frame candlesticks, like the previous day's low or previous day's high, or previous week's high, previous week's low, okay, or previous monthly high, previous monthly low, depending if you're talking about a buy program or a sell program. Now, and if we go into lower time frame, then you can now look at this framework in terms of maybe the 4-hour time frame market structure and stuff like that. But a condensed format of market structure is looking at it from the daily, the weekly, and the monthly time frame candlesticks. And that's why when we're talking about qualitative analysis, we also talk about candlesticks, because there's no way you can talk about qualitative analysis without talking about candlesticks, because candlesticks is market structure, candlesticks is how it's candlesticks give data and all of the stuff. You can't define what the next candle is going to be like without you looking at how the previous candle interacted with premium and discount arrays, how it interacted with key levels, how it closed and stuff like that. So that's candlesticks. It gives wholesome data about market structure essentially. Okay, so now I've had that talked about. There is absolutely no way, and we're going to discuss, we're going to use everything on the economic calendar to discuss this week's price action, how would look at this week's price action through the lens of the economic calendar. Now, after this lesson, okay, it would not make sense if you think you can go into the market and just apply it. You need time. Okay, the way I designed this program is the way I built my own trading system after I learned ICT, because when you learn ICT concepts, there's a lot of stuff there. There's a lot of stuff. And between 2020 and 2022-ish, I literally had consumed everything ICT dropped. And in 2020 alone, I had finished, the mentorship. And in 2021, I was done with his charter content, right? Very early in 2021. I didn't pay for his charter cost because by then all of his stuff was online, you get. So I had finished it in like 2 months and stuff like that. So I thought that was it. Just go into the chart and make some money, trade at will. That doesn't exist, please. There's nobody who trades at will. Okay, it's not possible. Yeah, I said that. Okay, you simply cannot, because if you have a system, it means you don't have free will already. That's what it means. Does not make sense. Okay, you are guided by your system and not by your discretion. Does not make sense. All right. So now that this is a little bit of story, because I figured I did not say enough story and I might come off as boring. But the truth is, I try not to include my personal life sometimes in my lessons, so that it doesn't, I don't build people that are just, oh, I know a lot about this guy, but just focus on the content or focus on the lessons. Okay, so after I finished all of those programs and stuff, I spent the following years trying to apply. And in the progression of my application, I started with the draw on the credit. Essentially, I started with trying to figure out how I can define the draw on the credit consistently. And I was thinking about numerous ways I can use to do that efficiently. I started with the COT hedging program. There were periods over the years when I couldn't trust the COT hedging program, and I was looking at candlesticks. And after that, I was like, okay, that's not enough. How do I validate? Because there are periods when I might get my bias right at the end of the week. Okay, listen to what I said. There are periods when I'll probably get my bias at the end of the week, not during the week, at the end of the week, because you can start bullish. The market doesn't show you bullish until maybe Thursday, Friday. So I'm like, how do I end up, avoiding losses early on in the week? Because then I now realized that I wasn't trading after the market had confirmed they were willing to trade in the direction of my bias. And that's when I tried to figure out, how do I validate my bias? And that's when I thought about, or I figured out the change in the state in delivery. It's how I validate my weekly buys on the 4-hour time frame. Does that make sense? So after that, that wasn't enough, because there are periods when you want to make money, high risk to reward, and you need to trade on the lower time frame chart. And I realized not every single day offers you an opportunity to trade in the direction of the high time frame, institutional order flow, or the weekly buys. So it means there are very specific days in the week you want to go in looking for day trades in the direction of the weekly buy. So I started thinking, oh, it has to be on the daily time frame. So the daily time frame is the key. Okay. Weekly time frame gives you the whole perspective of how to interpret market structure throughout that week. The daily time frame gives you perspective of what to do in that particular day. Okay, do you understand? So I started thinking, okay, what should I do? How do I, develop a model or a system that defines which day is high probability and which day is not? And while the economic calendar was always there, I never fully understood the economic calendar, but I knew that there are days or there are sessions in the day that's high probability because of the economic calendar, and there are also times of day that is low probability because of the economic calendar. And not just that, based on how market traded at certain time of day. And I started studying market profiles. I'm like, okay, if I can profile a market, I can determine if the market is likely to consolidate or expand, or just consolidate or expand, basically. Because if it's going to consolidate, I want to stay off. And now when I mean consolidation, it's either it's in a sideways market or markets are making retracement, because sometimes I see retracement as consolidation. Okay, for example, we can look at this week's price action and see all of the retracement in Euro USD into previous weekly low. That's consolidation. Okay, that's consolidation, and you can see the difference between all of those price action and the price action that unfolded today. You understand? So it's either is in consolidation or is in expansion. And what market does with respect to its draw on liquidity, whether it's the weekly draw or the daily draw, will determine what will happen in the next session. Okay, so this was how I was taking all of these years to determine or to understand this case studies and price action. So it's not, and all of this I was doing that with the basis of the knowledge I learned from 2020 to 2021. Do you understand? So it wasn't, I wanted to understand something, and I just refer back to how did it say, what did it say? When I mean how did he, I'm talking about ICT. What did he say about this and that and that and that? Okay. So if I want to understand consolidation, I need to understand, or if the markets like to consolidate, I need to understand the economic calendar. I need to understand the draw on liquidity and stuff like that. Now I'm outlining my thought process for someone who wants to develop their own trading model or their trading system. Okay. So you need to understand components that you need to learn. Okay. And that's how you build a system. You need to know what are you lacking and what do you need to understand. And that's where you focus on. You can't focus on too many things at the same time. There were periods when I was telling my very close friends that, okay, for the next couple months, we want to focus on patience. Okay, then when we're trying to build discipline, because we had a trading model then. I just freshly developed a trading model, and it was very exciting because every morning I'm so excited. I want to apply it because when you study it in hindsight, it looks very good, and I felt like I had hit a jackpot. Indeed, I hit a jackpot. You understand? But then the discipline to apply those things in particular framework, because that's the most difficult part in trading. All of those, when you backtest, for example, me, I do not backtest like that. When people say backtest, I just say long and short positions. I don't do that. I backtest the economic calendar. I backtest what I would have thought was the draw on liquidity. I backtest key levels, that's the PD arrays within the range. I talk about market profile. I write all of those details down. That's how I backtest. So I'm applying real world stakes in hindsight. That's what I do, literally. And this installment will just give you a heads up of how I do what I do. For example, earlier this week, I published my thoughts on Euro USD on Twitter. So if I were to backtest, I have something like that on Twitter already. Okay, but if I were doing it on my own, personal study, I would have more detailed because I record audios and stuff like that, and I hear it again. I play those audios. That's what I did back in the day. Okay, it's very obsessive. Okay, it's extremely obsessive. And so it's not like, I backtest and then in real time, what am I doing? I'm losing my balls. No, okay. I just try to apply as much of my system as I would in real time, and it helps me a lot. So that's how I would suggest someone study price action. Okay, you don't go there and say, oh, the market sold today, I'm going to look for my model inside all of. No, you start from daily candle. Would I have called this to be bullish or bearish? Okay, I would have been bearish. So were there any bearish validation before I looked for any short position? Oh, there was no validation. Oh, I have missed the trade. Okay, because maybe you were wrong on bias. You would have missed the trade, but you didn't take a loss. And that's something you want to note. Okay? Not every single time you make an analysis, you want to make money off of that analysis. That's stupid. Because if the markets aren't validating your analysis, there's no point putting money on. You're gambling. Do you understand? So these are the things you want to note, because I've been trying to avoid, this part of the mentorship, this part where I talk about day trading, because it is extremely complicated, extremely complicated. And if somebody listens to me the first time and think they've probably gotten everything I'm saying, I'm sorry, you won't. Because if this is your first time listening to me, or you've been listening to me over the past couple months or a year now and stuff, and this information is new to you, come on, you need time. Okay, you need time. You need lots of price action. And I'm picking this price action because it's like, it's the one where I actually talked about on Twitter. Okay, so that, I have like some sort of timestamp and proof of my thought process during the week. Okay, and it's actually a very complicated price action. I don't think it gets even more complicated, because we're going to look at the markets from the perspective of two lenses, and it's insane. You might not keep up. So if you're getting confused, which I hope you do not, because I'm going to be as audible and I'm going to try to explain it to the best of my abilities, but it's not enough. You're not going to listen to this one time. Okay, I'm encouraging you to listen to it at least 3 times, at least 3 times. Okay, and take notes, like write, because the best way for you to determine if you completely understand something is not when you like understood it the first time, is being able to write down your thoughts. If you can put down your ideas into thoughts, then you understand something. Okay, the reason why I was able to understand these things over the years, while I was thinking, okay, I was always writing pieces of my thoughts. I still keep journals. I still write. Okay, and it's not like watching ICT. No, I don't watch ICT anymore. I haven't watched ICT in a long time. Okay, but I write my own, experience based off of the teachings of ICT, and I know the things I want to learn, and I know the things I'm chasing after. Okay, if it's something about psychology, I try to find out, is there a way I can build my psychology in this area? How do I do this, and how do I do that? How do I, when I, go off the rails, okay, or when I'm starting to do dumb shit, okay, then I know, okay, I'm not doing something right. How do I retrace my steps? How do I get back in the zone? Okay, now getting back in this zone doesn't mean you can't take losses in the zone. You absolutely can, because markets can give you all of your confirmations, and they just smack you in the face. That's possible. That's market for you. Okay, but it means your next trade, it doesn't mean you do dumb shit because of that happens. You just repeat the same system over and over again. And now there are periods when markets are less complicated. So you can go on weeks not taking losses. It's very, very possible. You can go weeks, months without taking losses. So now that we talked about the bedrocks towards the draw on liquidity, towards interpreting the economic calendar, which is the draw on liquidity, it's everything we always talk about. Okay, both validating everything is hinged on the draw on liquidity, because if you cannot define where the markets are likely to go, then you absolutely cannot do anything. Okay, you don't have a trade. Can you trade if you don't know bias? Sorry, absolutely not. You can trade, and if you're wrong on bias, definitely you're going to lose money. So the extent to which you can make money, doing these things, is how right or how correct you are in your bias, allowing the market to validate that bias, and you taking trades off of it. Okay, that's milking, the rest of the opportunities that range has to offer. And that's why I center my analysis around the weekly range, so that even if you miss one day of opportunity, so long you trade in the direction of the weekly bias and the weekly time frame hasn't met objective, you still have an opportunity to take a trade. Does that make sense? So I think this is going to be long. All right, I think it's going to be long. And hold on. All right. So yeah, back to this. News drivers. Okay. So this is how I defined news drivers. I think it was one of the things I did first when I opened my Twitter account. So you can go back, or you can type news drivers or the economic calendar on my Twitter profile, and you're gonna see the things I said about it back in the day. That was, I think, in 2023. I said news drivers are the catalyst, of course, that takes price to the draw on liquidity. Okay, I can't remember the exact definition I gave back in the day. Oh yes, I think I remember. Okay, I said news drivers are they are catalysts that serve to drive prices to, I think, their intended draw. You know what? I think I'm gonna check my Twitter account, because it's a long time. I didn't plan for this. I slept very early today, say around 5 p.m. Okay, and I just woke up feeling like I need to record this video. The economic calendar, because sometimes I'm very cute with words, and other times I ain't so cute with words. Yes, so this was my definition in October 16, 2023. That was, oh, come on. I said news drivers on the economic calendar, the EC, serve as catalyst for prices to trade in the direction of the high time frame draw. Now this makes sense. Now this is where it gets complicated, really. I said, but in their delivery, they can be interpreted as either sponsorship or manipulation. And this is now the clause. Manipulation what? With respect to the draw on liquidity. Now, I gave a definition and I gave reality. Okay, that's the truth. That's one is definition, and the other is reality. Definition is the EC serve as catalyst for prices to trade in direction of high time from draw. Now, if we look at price action, euro, or say dollar index, at the start of the week, okay, bias was bearish on DXY, obviously, because I talked about how DXY is respecting key resistance levels, so there was no point to be bullish. Okay, there was no point to be bullish, except of course if they intend to manipulate, and that's exactly what DXY did this week. And DXY is closing bearish, which is very exciting and very funny at the same time, because up until now we had a very bullish candle on the weekly time frame. Now, if since we're bullish, the draw on liquidity obviously was the previous weekly low, at least that's looking at price action, because we're going to say a lot of things in hindsight. Please, we're going to do a lot of hindsight study, because this discussion about the economic calendar is very complicated, of course. So I think it's best we use something in hindsight, price action hindsight, to discuss, how it applies. Then you can always forward test it, and if you're lucky, if you get very good market condition, you can actually, it's always very easy. So you can see markets trading below previous weekly low, and that's salient to a bearish price action, because this is a bearish market structure running below previous weekly low. Now, if we were since we were bearish on DXY, it's actually normal for the markets to trade below previous weekly low. Say the draw on the crude was the previous weekly low, which always is, and you can see how DXY traded into the previous weekly low. So DXY trade into the previous weekly low, which was the draw on the crude, and how did DXY trade below the previous weekly low? If we look at, this is 10, Friday 10, that's London close, and there was a news driver today, London close, Fed, Powell made some statements, and DXY tanked and stuff like that. So I just want to go through all of that. So now I said news drivers on the economic calendar serve as catalysts for prices to trade in the direction of the higher time frame draw. If the higher time frame draw was bearish on DXY, we are seeing the news drivers will trade in the direction, help prices trade in the direction. Now, but in their delivery, they can be interpreted as either sponsorship or manipulation. Now, this one is a very over-exaggerated move, the one we saw today, very exaggerated. So that's clear sponsorship. But we're also going to look at the other side of this, okay, which is, we can see it in terms of manipulation and stuff. All right. Now, this is where everything gets very, very interesting. Okay. This is very interesting. The early portion of this week wasn't bearish on DXY. In fact, on Twitter, I was talking about, my thoughts on DXY, which, all right. This was August 19. I said, I recall discussing DXY's upside potential earlier, even though there was no basis for it at the time. Now, EU on its daily chart looks like the markets may be willing to revisit the previous weekly low. Now, I also talked about how London session would determine if I was going to commit to this bias or not, because, of course, on EU, we had a change in state in delivery, and since this is the change in state in delivery on the daily time frame, my thought process was the markets are likely going to draw into this level here, because this is the only key, this is key liquidity here. That's the previous weekly low. And you notice I didn't talk past the previous weekly low, because obviously I'm bullish, and a run below a previous low when the markets are significantly bullish. And that was one of the statements I made. I said something like, when I was talking about how daily time frame traded into, target here, I was talking about how some targets in a potential buy program. So this is where it gets very tricky, because when markets trade below an old level, an old low in a buy program, the chances of turtle soup should be considered. In fact, turtle soup is what I consider first before looking at any potential to go lower, right? And I also talked about why the economic calendar points to the latter portion of the week. That's Thursday, Friday, for any potential volatility that may drive prices to their intended draw. Okay, because we started this week with the bias to be bullish, all right? And the market had two levels for draw this week. So the first draw on the crude this week for the markets was what? The previous weekly high. And after the markets trade into the previous weekly high, which we understand that when market structure shifts, because this is a low, this is a high, this is a low, markets making a high. When market structure shifts against the high time frame institutional order flow, that's a turtle soup. So we had two draws this week. I already said I would try to avoid any market recap, but that's obviously what I'm doing. But I'll try to limit it as much as possible because when we are trying to discuss the economic calendar, we need all of these facts right. Because in the definition, I said they serve as catalysts for prices to draw. Okay? I've forgotten that definition again. I don't know. There's so many things going through my head. I have a lot of things to talk about, and I can't keep a definition in my head. Currently, economic calendar. This one has to go to my profile. Economic. My Twitter account really is just it's everything good. It's October. It's in October 18. Why why am why am I not saying it? Oh shit. I I can't go back in time. That's incredible. That's incredible. Okay. Anyway, every one of us saw the definition and how I was talking about how, you know, this the news event serves as a catalyst for prices to trade into their draw, right? So if the early portion of the week was bullish for dollar index and the draw on liquidity was on buy side. Now, mind you, in hindsight, all of this move here is manipulation because all of this move against the high time from institutional order flow is manipulation. All right, so it's getting even complicated now. Mind you, I said in the delivery of the news driver, they can be either seen as manipulation or sponsorship. They are sponsorship when they trade in the direction of the high time from institutional order flow note, and it's manipulation when they trade against the high time from institutional order flow. But when the markets were trading in the early portion of the week, this was a draw liquidity. So if we're seeing the news driver trade in this direction, that's sponsorship. But after all of this trade, I hope you don't get confused. Everything that's happened until now is manipulation. But let's take it a day at a time. So we're going to go to the EC, and knowing for a fact that the draw on liquidity on the dollar index for was the previous weekly high. Okay, I think I'm going to limit the amount of study we do on this so that you can easily commit it to memory, and because everything we'll talk about is everything you actually need. Okay, subsequent price action you can always build on this foundation, right? So we look at Thursday's trading. All right, since we think, or since we now see in hindsight that the draw on liquidity for the most part of this week, okay, was the previous weekly high on dollar index, and that means Euro USD were bearish for more than the first half of the year. So we are thinking, or we know that since the draw on liquidity was bullish for DXY, we're going to look at the EC, and then we're going to look at price action, and we're going to study it, and we're now going to draw our conclusion from it. Okay, so I'm going to start with Thursday because I just want to look at Thursday and Friday, because when I was talking about price action on Twitter, I was saying markets were going to move to their intended target using the economic calendar on Thursday and Friday. Okay, so we're going to look at Thursday. Now you'd see there's a news event 8:30 euro and 1:30 for dollar index and 2:45 and 3. So DXY. This is Thursday's price action. this is Thursday's price action, and gonna look at 8:30, 8:30 time of day. This is put the session breaks, and I'm gonna take this one out. I'm gonna take it out for now. So this is Thursday's price action. Okay, so DXY is bullish. Okay, DXY is bullish, and we're gonna put this here. We're gonna put this here. Oh shit. So we're gonna put here, this is previous day's high, the top. I'm gonna put a top here, because this is the only way you can understand this, really. This is the only way. So this is previous day's high. Now you can see on Thursday, the early portion of Thursday was bullish for the XY, and if this level here is the draw on liquidity, okay, and markets traded through into previous day's high. Now I taught market profiling. Okay, I told you this is the day trading saga, and there's no way we'll be talking about price action without referring back to all of those lessons: the draw on liquidity, market profiling stuff. Okay, when market trades overnight and market meets objective, London session is what? Low probability. That's fact. Why is London session low probability after trading above previous day's high? It's because the markets can return into the range. So I'm not going to wake up on this day and just say there's probably liquidity here and stuff like that. No, I'm referencing the fact that markets traded above previous day's high first, and there's something on the EC. There are lots of red folders, and I know that the economic calendar can be viewed as either sponsorship or manipulation, okay, with respect to the draw on liquidity. Now, on this fact, the previous day's high has been met, but we still have the draw on liquidity here, and market has scheduled three different, slated three different times on the economic calendar for news. That's 8:30, the New York session, 3. Okay, 3 in the morning, that's about 8 o'clock Nigerian time. 1:30, that's 8:30 New York time. And the London close session, that's 3 p.m. Nigerian time, then 10 o'clock New York time, right? So markets traded above previous day's high. And when markets trade above previous day's high, that's an objective. You want to wait. And it's the same thing, I was talking about on Twitter, when I was saying when I did this thread on Twitter, I said my thoughts on EU this morning. I said I started this week with the bias to be bullish, which remains so. However, there's no validation on this daily time frame, blah blah. And I also talked about how London session today has seen prices return into some previous days low after expanding through Asia. This automatically disqualifies London as an ideal window for short. So even if I want to go short on EU, I can do that in London session. Why? Because markets has expanded overnight and traded into an objective. So you need to wait. I need to wait. Okay? So it's literally the same thing here, where even if you know that this is a draw, okay, this is a draw, and you want to trade on Thursday, where Thursday is your one shot, one kill for markets to expand into this draw finally. Okay, that's your one shot, one kill. Thursday's trading. But markets meeting objective above previous day's high. When? Look at the EC. 8:30. Okay, there's something coming out in the morning. There's something 8:15 and 8:30. Okay, so we're gonna go to the 15 minutes time frame, because 15 minutes time frame breaks the whole thing apart. So when markets traded above, you can see the first driver, 315 here, sells off after meeting objective. This is the news event. sells off again 8:30. That's Nigerian time, but 3:30 New York time, right? And if we look at it from the perspective of the weekly bias, which the drawn liquidity here is what the previous weekly high. All of this moves here is what? Manipulation. Is what? Manipulation. But you know the funny thing? Somebody who is a scalper and who thinks the markets are possibly going to trade maybe into this liquidity here. Okay, this liquidity that someone might call inducement here. If somebody thinks the markets are going to trade here into this mitigation block, that trader can actually go short here. That means the person is going to sell the news on dollar index because the person thinks this is a drawn liquidity. And if the person thinks this is a drawn liquidity, this is what? Sponsorship, because this is the drawn liquidity. But in the grand scheme of things, if the markets are bullish on the daily time frame and the market has a propensity to reach for this level, all of these moves here will be seen as what? Manipulation. So here, manipulation. Because this folder is for Euro USD, of course. So it's kind of like different. You can see how markets were just rallying on Euro, rallying. All of this rallies, manipulation. And you can see if this is the drawn liquidity, how can you determine if this is manipulation? You can see we have the liquidity here and we have a market structure shift. If this is the drawn liquidity, the previous weekly low here, sell side, here is the drawn liquidity, and market structure shifts. This is a bullish market structure shift, not this thing here where someone might call out and say this is a change in the state in delivery. It's not a change in state in delivery if it's against what? The drawn liquidity. And that's why all of these things, your model is very, very subjective. It's rooted in the drawn liquidity. Without the drawn liquidity, nothing makes sense. Okay, and that's why we have concepts in price action that can help you understand price action. Like I said, market structure is very, 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 very subjective. Everything is subjective. You need to put things in proper context. So when markets trade above this high, that's what? That's a Tory soup. And now, what do we have here? We now have a what? We now have a change in state in delivery. We have a change in the state in delivery. Now, this is a change in state in delivery. Why is it a change in state in delivery? Because after markets trade above this high, and we have a change in state in delivery, and we have the drawn liquidity untapped here. So when we see this, is an opportunity to be short. But I'm not going to base my execution based off of the change in delivery, because we are going to look at the economic calendar, and that's what we want to focus on today, not the change in state in delivery. So looking at the economic calendar, we've seen the early portion of the news on Euro USD was manipulation. Why is it manipulation? If the drawn liquidity as the previous weekly low on Euro and Euro USD rallied higher, okay, using all of these folders, that is manipulation. But I also talked about the fact that if somebody was scalping or saw those levels on Euro USD as liquidity for London session, if somebody woke up in London and saw all of these levels as liquidity, then the person can actually just buy this candle here to 315 to capture, the buy side liquidity resting above this high. That's sponsorship for that person, because it's with respect to what? This draw. But if we look at it from the perspective of the weekly time frame, as the candle is gravitating towards the weekly drawn liquidity, which is the previous weekly low, this will be seen as what? Manipulation. Not market structure shift, manipulation. So we move to the next one, which was coming up in 1:30. That's a news for dollar index. Okay, so we look at dollar index. Now that we've seen that all of this is manipulation because of what? The news driver. And then what do we have here? We have what? A change in the state in delivery. We have a change in state in delivery after what? Market traded into this consecutive down close candle. Let me drop out a key level or something so it can be very easy to follow. So it's not like, let me drop this auto block here. This auto block, we have an auto block here. We have this auto block. So just see how insanely subjective this market is. Insanely subjective. Okay, the markets are very, very subjective. Okay, I'm going to put this here. All right, so we have this, you can see this consecutive down close candle. That's why we say a change in state in delivery is the order block. So we have the order block, markets trade down into a discount, the order block, and we have the change in state in delivery like we saw in euro. So ideally, if you want to trade without the news event, the news driver, as soon as the market return back to the order block here at 7 o'clock, that's New York open, you can buy and target here. But we want to study the economic calendar and how the economic calendar actually, how we can interpret the economic calendar. Because if you're on this trade and the market suddenly return back here, how would you feel? Okay, would you make an impulsive decision to close the trade? Or would you hold the trade trusting in the order block? Because all of this return back to consolidation, to this order block, it just shows that market just decided to consolidate first before actually expanding. Okay, like I said, retracement can be seen as consolidation. Market expanded, return back to a key level. And that's why times and times again, you do not need to break even if you're very sure of your trades, because if you can trade off the order block and you leave your stops open, markets can consolidate for as long as possible and still eventually still reach objective. So if you move your stops even here quickly, you get stopped out and you miss the move. So once you take trade, leave your stops until market has run, significantly, and you can take partials and stuff. So we have the order block here, which is the change in state in delivery, and we want to study what price action is. So at 8:30, look at this candle here, 8:30. You can see what the market did at 8:30. Market sold off. We have a change in state in delivery, validating what the daily bias after market traded into the order block on the 12-hour time frame. We already interpreted everything that happened here. We're calling it manipulation because why? The daily bias is bullish. It was bullish, but market quickly met objective at the previous day's high. So when that happens, and with all of the drivers slated on the economic calendar, there's definitely going to be manipulation. In fact, there was something I wrote down in my journal. I said when there are multiple news embargo, I try to avoid the first ones as much as possible, because the first ones are usually manipulation and the sponsorship occurs in the later half. You understand? Most likely, definitely, most times, always the last one. So if you want to look at price action in hindsight here, okay, you want to be looking at those drivers coming up in New York session, and you want to be looking at market structure prior to the news drivers. That's how to trade. Okay, so you want to be looking at market structure. What was market structure like prior to news driver? Is market structure indicating that, because all of these things is within the framework and the context of the drawn liquidity, is the market structure validating that markets are going to resume bullish because we had manipulation for the early for London session. Now, mind you, before London session, the daily candle would have been very bullish and convincing that markets are going to head for here. But if you do not profile your markets appropriately, or if you don't have a reason why markets will do this, you're definitely going to lose your bias by this time. Because when markets now trading to a key level and you see a change in state in delivery, you cannot trust it anymore. That's why you need to profile the markets and define what session, what time of day is high probability. And I've given several instances how to qualify sessions. I said when you see markets expand in Asia, definitely London most time is low probability. Now you've seen on other instances where markets expand in Asia and there are multiple news events lined up on the economic calendar for Thursday. So definitely London session is low probability. Now low probability is also very subjective. when we're talking about probability, it's also with respect to your bias, your draw on liquidity, because you have to have bias. You can't sit on the fence. You have to pick a side, really. Are you bullish or are you bearish? Because it's only when you have a side you can successfully interpret market structure. Okay? So, now that we have a change in state in delivery and it's New York session and markets return to order block, well, that's great for buy. But you can see what happens. 8:30, market just ran down. If our bias is bullish and market sold off us at 8:30, is this sponsorship or manipulation? Yeah, it's manipulation. Why is it manipulation? Because it's against the what? The drawn liquidity, which is the previous weekly high. That's simple. That's what it is. Now, how do you trade this? Well, there's a 30 minutes change in state in delivery, just like the way we use the 4-hour time frame to validate the weekly bias. You use intraday market structure to validate the daily bias at key level, at key time of day. We're still going to get to day trading model, okay? We're still going to get there. So you want to use the 30 minutes time frame, market structure, change state in delivery to validate your daily bias at key time of day. So there's a change in state in delivery prior to what? New York session. So market utilized the order block, rallied, and the news embargo came out, sold off, but market structures validated daily bias. So market returning back to the order block is fair. And then what happened? Market returned back to the order block and what? Rallied. Now there's something else. We have 2:45 and we have 3 o'clock. So say somebody doesn't trade the change in state in delivery here. There are different ways you can get in on the setup, really. There are absolutely different ways. Okay, you can reference this down close candle here. And as soon as the market closes above, this is your change in state in delivery, and you want to buy the next candle. Yeah, that's it. Or some folks can use this as what? Folks can use this as, the inversion fair value gap. So as soon as the market closed above this inversion fair value gap, and you know that market here has respected the order block, market is coming off of the order block, and market has respected this inversion fair value, you can buy the inversion fair value gap, and you can put your stops here. Why can't you put your stops here? Market is traded below sell side liquidity here. But if you want to be very conservative, you can also return your stops back here. Someone who's aggressive will put stops here because market ran liquidity here, but conservative will put stops here because this is a reference point for everything that's going to happen in New York session. And you don't know what's going to happen here. You don't know if markets are going to return back here or markets are going to run this low and continue, because the market can absolutely run this low. And if market runs this low, we just have 1, 2, 3 drive and market expands. You'd say, why didn't you? Come on. That's why you need to know price action and understand that markets can do whatever the markets want to do. And there will always be a justification for that in price action. Markets can always be justified. The only thing markets don't do, a lot of times is running key levels, like running, swing points. But when even an ideal level can be swept. For example, look at Euro USD. Last week's price action, we had a bullish weekly close, and Euro USD still ran below previous weekly low. That's not ideal, but it happens. Does it happen frequently? No, but does it happen? Yes, it does. So the first one was 8:30, market trade into order block. We said this is what? Manipulation. Why is it manipulation? Market's trading against what? The weekly time from drawn liquidity after market validated the daily bias. So at 8:45, there was another news embargo, and that was this huge gap. So this is 9:40. So prior to the news at 9:40, sorry, at 9:45, okay, there was a change in the state in delivery, and you buy. And for this one, you can use this level here for stops, okay, or you can put your stops here. Aggressive would place your stops here. Conservative will place your stops here for this setup. So you can see each setup has its requirement. Here, I said if you want to be aggressive, you can buy this and place your stops here. But if you want to be conservative, you can place your stops here. I say here, if you buy here at the next candle, okay, you can place your stops here or place your stops here. And you can see what the market did. There was a gap here, but the gap it doesn't reflect on every chart. It is just capital.com here. And the next event, this is 9:45, and this is, where's 10? There's 10. Okay, this is 10. I don't think anything significant happened at 10. 10 is this medium impact. So for the red folders, we can see how markets responded to it. So you can see how it's not just about talking about the economic calendar. There's a lot of things to talk about. You want to talk about price action. You want to talk about market profiling. You want to talk about the drawn liquidity. You want to talk about key levels. So I can't just come on and say, today I'm going to teach economic calendar, because it does not make any sense. I need to have taught a lot of things. And that's why I taught the drawn liquidity. And that's why we teach the weekly bias. And this week, I did profile the markets on Tuesday. I was talking about how the market could actually trade into the previous weekly low. But since that was against my bias, of course, I was unwilling to take trades until Thursday. Now, Friday, today, I slept throughout the afternoon because I've been watching, Prison Break again. So I've been spending most of my nights watching Prison Break. So my daylight is wasted. And I didn't expect so much from price action again. I was just thinking, how would the market close? How would the market close? And Powell, it's very interesting. This market is very, very interesting. So that's Thursday's price action. We went through Thursday's price action, interpreting the economic calendar, and that's what this whole video is about. Teaching and telling you how to interpret the economic calendar, because there are moving parts to it. There's the drawn liquidity, which is most important, and there's market profiling too, because like I said, this is day trading saga, where everything we're doing would help in day trading. You can see the risk reward has significantly increased, and just based off of Thursday's price action, there are multiple setups that you can consider from the 30 minutes change day in delivery here, 1, to this one, 2, and this one, 3 setups really, and that's great. Okay, for someone who's curious, I don't really like all of this risk to reward thing. I just find my setup and I just take my setups really. So this is a drawn liquidity here. We have 5 risks to reward. Okay, because you successfully profiled the market and you avoided London session, and there was not a change in state in delivery, something that validates your daily bias, and you engage and you allow the markets to do its thing. That's 5 hours. Then if you want to go a little bit crazy here again, let's pick this because this level simply highlights the inversion. So this is 3.62, and if you increase your stops here, this is 2R. Fair with this much range of stops. Very conservative, but it keeps you in the trade. But this aggressive, fair, only if markets would expand. That's the only way this will be maintained. You get. So, but of course, as soon as the market closed above this candle here, you can always move your stops from here to here. That's trade management. Hopefully we get to that portion in the mentorship. And for the final trade, we have this one. For conservative, that's 1.95R, but if you're being aggressive, this swing low here, 3.7. So just from one daily candle and interpreting the economic calendar. So we go to today, which is Friday. All right. Friday's trading. So everything on the economic calendar is slated for London close. So even if you have bias or anything and stuff like that, I don't know what you want your bias to be. Well, you can think about having like a continuation for maybe dollar index to go higher. Initially, I was thinking that if the markets would continue to go higher, I was thinking the markets may be interested in coming up here, this inefficiency here. That was what I was already thinking. But first, I told myself that I need to wait because this could be a Tory soup. Likely first, Tory soup first, then continuation into this round career. That's it. I have to think about the two possibilities, okay? Because if there is any possibility that it will be a continuation, then I could reserve that for next week and think about maybe we were wrong about how the market was going to deliver this week, and the market wants to run to a premium first, then sell off. Because regardless, I would still be sort of bearish on dollar index, but the actual was doing something on the weekly time frame. By the time they were trading above this high, there was almost like some sort of weekly change in state in delivery. Okay, I'm going to show you. So at the point when they were trading above here, they were trading above this. They were trading above this consecutive. You can see these consecutive downward candles. Okay, they were closing bullish or almost closing bullish above this. So that would have really complicated this week's commentary. But I'm glad they closed like this. You get so in an ideal scenario, say you anticipated that the markets were going to trade above previous weekly high, and you understand the fundamentals of market structure shift against the draw on liquidity, because this is the draw on liquidity. Okay, the draw on liquidity after market obviously I have to put that, okay, after markets traded above the previous weekly high. You understand? So markets went internal range first and traded above below here. Ideally, since there was a change in state in delivery here, which makes this level high resistance and market structure shifting again. So those really a lot of there's a lot of things to talk about above this high, really. So let me just go back to the intraday time frame. So after market met objective above previous weekly high, and we see the markets come out in London close, there was price action I want to call your attention to. Yeah, you can see this short term, you can see this run above this high, you can see this run above this high prior to the news driver. Okay, this was a market structure shift. Okay, you can see this market structure shift, okay, and the news driver. Okay, very, very, very incredible. Okay, market structure shift. Oh, this is a change thing delivery, and imagine when you just buy this. Come on, it's gonna be crazy. Like it's gonna be very crazy, and you think you buy it, and you don't want to wait. Anyways, so you can see in this case, the markets traded with respect to the weekly bias, and this is sponsorship. So while in hindsight, okay, all of this price action from Monday, Tuesday, Wednesday, Thursday, all of this price action is manipulation. Why? Because it's against the weekly bias. So I don't want to. I'll leave it like this. I would not. I don't want to complicate anything for anybody really. I don't want to complicate because it's intense already. Okay, so you can see if you want to understand the economic calendar first, you need to understand what the drawn liquidity is, because it's only when you can understand the drawn liquidity you can understand market structure. Market structure is very, very subjective. Market structure is highly subjective, highly, incredibly subjective, incredibly subjective, incredibly subjective. I'll say that again. Market structure is incredibly subjective. A shift in market structure, all of those things, none of that mean anything if you cannot define where the market is going to go. So that's why if I think I'm wrong on bias, I'd rather not place a trade, because market structure can show me anything it wants to show me. And I'll think, oh, what if, wrong on bias can come out like this. The early portion of this week, I was bearish on dollar index. And then, or say, let me use Euro USD for example. I was bullish on Euro USD. And later I began to see market, not validating longs and looking like market wants to trade into the previous weekly low, which was what I shared on Twitter. And for those little instances where the market might show me that they have interest to go long, and if I trade it, I'm definitely going to take a loss. You understand? And it could be maybe I try it on Tuesday, take a loss, try on Monday, try to take a loss and stuff like that, because I'm trying to trade my bias. I'm not allowing the market to validate my bias first. And that's why if you want to validate your bias, it's the 4-hour time frame. It's the 4-hour time frame, basically. Say we had the bias for markets to return into the previous weekly high first. If that was what was in our minds, because obviously I wasn't anticipating the markets to trade into this, because we already had to change the delivery and all of that. Okay, so I think price was around here. Oh, this was our market close on Friday, so there wasn't so much data, okay, that we can use to determine how the markets were going to trade until the week started, literally. Okay, so if you look here, where's Monday? I need Monday. Okay, so this is Monday's trading. Okay, it wasn't up until this is Tuesday. You can see this Tuesday's price action. You can see this is Tuesday, right? Okay, this is here. It wasn't until there. It wasn't until there we had market validate, bias to run into the previous weekly high after there was a change in the state in delivery here on Tuesday. That was New York session. So this is the rest of Tuesday, Wednesday, and all of that. So you can see how Wednesday's price action, the market stayed and consolidated around this level, continuously, just consolidated. Thursday, when you ran above previous weekly high and previous day's high, return back into the order block. And we're going to make reference to this. You can see that change is state in delivery on the 4-hour time frame. Can you see it? That's where markets trade into. You can see that change in state in delivery is the key level market return back into here. And it's where the market spent a lot of time here on Wednesday. The change in state in delivery on Tuesday. Market spent a lot of time on Wednesday here. Return back here intraday on Thursday. And the order block or the proportion block that formed after, market return back into it. So you can see how I'm narrowing your focus. When we started very big, I know my voice has significantly reduced. It's because we're nearing the end of this particular video. So I'm trying to recover my strength from talking. I don't know how long I've talked. Okay, so you can see how we talk about withdrawal liquidity. Okay, we talk about the COT hedging program. I said there are other ways to define, quantitative analysis. There's interest rate differentials and stuff like that. You get all of those things still support dollar index to go higher long term. But like I said, or like we know, institutions and all of this stuff, they are deep pockets, and the markets are currently trading against their sentiment, because what the COT aging program is literally what the big guys are really onto. So they are holding on to massive losses based on COT hedging program, and it doesn't mean because they have a lot of money. Okay, so when the market is done with what the market wants to do, markets will run to its intended target. But we as day traders, we do not have that luxury. Okay, we do not. And while we look at data, we can also look at candlesticks, because there are periods the two of them don't align. This week is a very Good example. Last week, bullish in euro, but the first half of this week was bearish consolidation, and suddenly the markets was just expand. If everyone listening here has deep pockets, you know what you're gonna do? At the open of this week, you're gonna buy Euro USD, and you probably put your stop loss somewhere, maybe 300 pips below, and hold and wait. So when markets were done with whatever they want to do, and markets finally expand like this, I mean, you're back to even and you're on profit, because next week is going to be very interesting. And you know, the funny part is that if next week happens the way I think next week will happen, you know, a lot of folks will still miss out on the move. And then you'll be wondering how when markets are in your favor, you're missing move. When markets are not in favor, you're still taking losses. You know, it's very crazy market. And that's why I'm teaching price action. I'm not just teaching a particular strategy. And if it's a strategy, obviously the change is staying delivery. I'm only gonna include one more price action model. So the change is staying delivery. Those are the only two price action models I'm going to teach for this day trading saga, whatever. Just the change staying delivery, because we're trading on the 4-hour time frame. But now we are going to be looking at it very well on the 30 minutes chart. Okay, 15 minutes, 30 minutes I prefer because of it's more condensed than 15 minutes time frame. Okay, so that's what it is really. The EC news drivers, they serve as catalysts. They help price trade to targets. But then in their delivery, how they trade is what really matters. That's what is subject to interpretation. Why price action here is still a lot more favorable is because we already had a change in delivery. There are periods when absolutely nothing, you wouldn't see any market structure shift. Probably market trade down, just consolidated, and the news would help in the change in the state in delivery. There are instances like that. Now there are different ways markets can unfold. And when that happens, you want to wait for markets to return into fair value and buy it, because then the fair value gap the markets create, if say for example this move here was a news driver, and you can see how markets create a fair value gap here, this fair value gap or this auto block, if you want to be aggressive, you buy the fair value gap, but if you want to be conservative, you buy the auto block here. So if you buy a fair value gap, which is, I'm always aggressive, mind you, my interest, I can't spend a lot of time thinking about trade, waiting patiently, and when it's time to execute, I'm conservative. It doesn't make any sense. So what's all the patience for? I unload my impatience on my entries. That is, sometimes I don't have good entries. Sometimes my entries are sick. I don't care about my entries. I absolutely do not care. My entries are sick sometimes when I'm aggressive. Sometimes I take a lot of drawdown. I still do not care. My intention is, can the market trade? With all of the information I've interpreted in price action, I hope I'm right and biased. Because if I follow my rules and I take a loss, it means I'm wrong and biased. That's what it means. And it's fair. I'm okay with that. I'm okay with that kind of loss. But I'm not okay with loss of a junkie, someone who just trades because, or someone who gambles. That's not the kind of loss I want to be taking. So, if this was a news driver and you see a fair value gap like this fair value gap is sponsorship. Especially if, you know, like this, there's a drawn liquidity here. In the same vein, if the news driver trades above an old high, let me show you how interesting the market is. This market created a fair value gap, right? There was a change in delivery, but this is still what? Manipulation. So all of this, a fair value gap created by a news event, doesn't mean shit. What do you need to focus on? The drawn liquidity. Because only if you know the drawn liquidity to a great degree of certainty, you can interpret market structure, you can interpret price action and whatever. So you can see how Euro USD trade 830, rallied up, 930, trade lower. Okay, so I want to give someone something. Okay, say for example, you saw the change staying delivery here. Somebody should have that question and said, oh, what if I cannot trade this yet because of the news driver coming out on in 8:30 and 9:45. What am I going to do? Well, first off, you have this. You have to outline it first. That's the first thing. You want to outline the key level. And then what happened? Market, 8:30 markets, there was an announcement and market rallied higher. Remember, there's something in 9:45. And mind you, your draw is what the previous weekly low here. So when markets is rallying, you might as well be thinking, oh, possibly market trading to this discount gap and markets are going to rally. Be patient. You have to be patient because all of this candle is a lot of time. This 30 minutes, this is 1 hour, this is 1 hour 30 minutes. That's a lot of waiting. And then what happened? Market revalidated your bias for this, and you what? You sell and you target here. That's it. That's it. So personally, I don't trade the news. At least not in this sense where the news is coming 1 minute for the news release, I press buy or sell. I don't do that. I don't think I've done that in years. Like I'm talking about maybe 4 years and stuff. I don't think I've done that. And periods when I take trades, maybe I missed the, or maybe I didn't know that there was something coming out. Maybe I didn't check that day and I took trades, something like this, and markets. Maybe I took trades and the next 15 minutes was, the news event and markets rallies, or probably hits my stop. I'm like, oh wow, there was something coming out. You understand? So you can always take trades using the economic calendar. It doesn't mean you have to take the trade 1 minute before or 1 minute after. You don't need that. That's too risky. Because if you did that in the case of today, you lose your account. I mean, you're going to lose a lot of money because there's going to be insane slippage. You're going to lose money. Your losses will be capped where the candle stops, pushing your stops. Very incredible because I've experienced it this year. I was trading crude oil and crude oil gapped. Jesus Christ, that's very crazy. Crude oil gapped on my entries. First off, the market froze on Xness. The market froze and then it gapped on my entry. Very horrible. I don't know. Personally, I don't see myself as lucky type. Okay, I cannot make a mistake and be lucky. It rarely happens to me. So that's why everything is manual for me. Okay, I have to understand everything because I don't trade on the basis of luck because I don't think I'm a lucky person. I may be very intelligent. I'm very, very smart, but maybe that's what removed the essence of luck because I'm very self-aware and self-conscious. So because of that, I can't make a random lucky decision. It's very difficult for me to do that. Very extremely difficult. So if you still got luck in yourself, then that's great. Someone said ignorance is bliss. Because if you don't know too much, you can, fool here and there and be lucky. But if you know too much, like me, for example, I know a lot of things in price action. So I cannot just go to the chat and just make stupid decisions. And, throughout this week, I was joking with my guys. I was telling them that, I've not seen price action like this in a long time. You're doing analysis to avoid taking a loss. It's not like I can join bias, but, my bias was obviously wrong from the early portion of the week. Market decided to consolidate, so I'm definitely going to take a loss if I try to trade in the direction of my bias, which is bullish for euro. So I was just avoiding, taking losses by saying, okay, markets are invalidating yet. Oh, market's likely to go here now, stuff like that. So remember where we started from, how we started from, and where we ended, and where we're at right now. The elements we talked about that you need before you can understand this, how the economic calendar plays a role in all of these things, the draw on liquidity and stuff. I hope you found this one insightful. On to the next installment. Be safe.